Okay, let's talk about something fascinating. What if I told you one of a company's biggest, most important assets is something you can't even touch? Nope, not brand value. It's a promise. More specifically, it's a customer's promise to pay. And today, we're going to dive deep into the high-stakes world of that unpaid bill.
And this right here, this is the core of it. It's this massive balancing act between the money you're supposed to get and the money you actually get. Think about it. A company makes a sale on credit, and bam, an asset goes on the books. But is that asset solid gold, or is it just a stack of IOUs that might never get paid? You know, getting this right can be the difference between a booming business and a total financial wreck.
So, let's really dig into this with a simple question. When you think of an asset, what comes to mind? Probably stuff you can touch, right? Buildings, computers, cold hard cash. But what happens when one of your most important assets is, well, just a promise?
Well, that promise actually has a name. It's called accounts receivable. That's the official, accounting term for all the money customers owe a company. The easiest way to think about it, it's the business's official IOU collection. And look, this is absolutely fundamental to how modern business works. But, and this is a big but, figuring out what those promises are really worth, that's where things get tricky. Okay, so let's get down to brass tacks. Where does this all start? The moment that IOU is born. A customer buys something on credit, the company records the sale. Simple, right? Well, not so fast. This is exactly where the first layer of complexity starts to creep in.
Because what's really interesting is that the initial promise, it often has some strings attached. So you've got your simple trade discounts for things like bulk orders, but then you have cash discounts, which are basically incentives to get customers to pay up faster. You've probably seen this before, terms like 2/10, N/30. It's basically the company saying, hey, pay us in 10 days instead of 30 and we'll knock 2% off the top. And right there, that's our first big accounting question.
And this question leads to two totally different ways of handling it. First, you've got the gross method. This is the optimistic approach. You assume the customer's not going to take the discount, so you book the full invoice price. If they do pay early, you just adjust it later. Then there's the net method, which is more conservative. Here, you assume the customer will take the discount, so you record the sale at that lower price from the get-go. And if they miss the window, that extra 2% they end up paying just becomes a little bonus revenue for you. But honestly, discounts are just the tip of the iceberg. The real problem, the one that keeps CFOs up at night, isn't about customers paying a little bit less. It's about customers not paying at all. And this is where the nice, clean world of accounting runs headfirst into the messy reality of business.
And yeah, this is the hard truth. Some of those IOUs just will not get collected. It happens for a million reasons, right? A customer goes bankrupt, there's a dispute over the service, you name it. The point is, some promises are going to be broken. And any company that just pretends this won't happen isn't just being optimistic, they're being reckless and misleading everyone, including themselves.
So you might be thinking, okay, why not just wait until a bill officially goes bad and then deal with it? Well, you can't. And the reason is a really important accounting rule called the matching principle. It basically says you have to record the costs of a sale in the same period as the revenue from that sale. You can't book the income in January and then the related loss way out in December. It just doesn't work that way. It forces companies to look ahead and plan for this stuff.
The modern solution to this whole problem is a model called CECL. That stands for Current Expected Credit Loss. And the most important word in that whole phrase is expected. Instead of just reacting to bad news after it happens, companies are now required to actively predict it. Right from day one of making a sale, they have to estimate how much of their money they genuinely believe they'll never get back.
And this isn't just pulling a number out of thin air, it's a whole process. Step 1, you look at your own history. What's your track record with bad debt? Step 2, you look at what's happening right now. How's the economy? Are your biggest customers doing okay? And finally, step 3, you have to make some reasonable forecasts about the future. It's this really cool mix of past data, present conditions, and a bit of educated fortune telling.
So that's the theory. But how does this all actually show up on the books? How does a prediction turn into a real accounting entry? All right, let's get into the nitty-gritty.
Okay, so companies set up this special account. It's called the allowance for credit losses. The best way to think of it is like a company's rainy day fund, but specifically for bad debt. Technically, it's a contra asset account, which is just a fancy term that means it's a negative number that sits on the balance sheet and reduces the total value of accounts receivable. It's what gives you a much more realistic picture of what a company actually expects to collect.
And this rainy day fund has a pretty clear life cycle. First, at the end of a period, the company tops it up. They make their estimate for future losses and add that amount to the fund. That addition is what we call the credit loss expense. Then, Later on, when a specific bill is confirmed as a lost cause, they do a write-off. They take the value of that bad bill out of their gross receivables and out of the allowance fund. But sometimes you get a surprise. A customer who you'd given up on actually pays. When that happens, you just reverse the write-off and happily record the cash.
Now, this is absolutely crucial to understand. When a company finally writes off a bad bill, the net amount of assets they report doesn't actually change at that moment. And you might be wondering, how is that possible? Well, it's because the financial hit, the expense, was already recorded back when they first added money to the allowance fund. The write-off itself is just confirming what was already planned for.
So how do they come up with a number to put in that fund? One of the most common tools is something called an aging report, and you're looking at a simplified version right here. The logic is dead simple. The older an invoice is, the less likely you are to ever see that money. So you can see they apply a bigger percentage for expected losses to the older bills. You add it all up, and in this case, the company figures it needs to have about $37,500 set aside in its allowance fund.
All right, let's pull back and look at the big picture again. Why do we go through all this trouble? Why does this careful estimation and all this accounting jargon matter to you, or to an investor, or to anyone who just wants to know if a company is actually healthy?
You know, it really all comes down to one simple concept: financial honesty. When a company does this right, when it properly accounts for its expected losses, it's making sure its balance sheet reflects reality, not just wishful thinking. It gives everyone, investors, managers, everyone, a much clearer, more honest view of what the company's assets are truly worth.
And this idea of honesty is exactly why the old, simpler way of doing things, the direct write-off method, is just not allowed anymore under U.S. accounting rules. It's because it totally violates that matching principle we talked about. It paints a really misleading picture by letting a company report revenue in 1 year and the cost of that bad sale maybe years later. The allowance method, on the other hand, forces them to be upfront about potential losses from the very start.
Which leaves us with a really powerful final thought. The next time you're looking at a company's financial statements and you see that big accounts receivable number, I want you to ask yourself how much of that is basically cash in the bank and how much is just a promise that might get broken. The answer to that question, well, it tells you an awful lot about the real health and the real honesty of that company.